Our panel tonight, this is really a good topic. This is really a solid topic. Real estate financing, an overview of current lending conditions. The evolution of this conference really came about as Albert Nunziata and I had discussions with George Canis of UBS Financial Services. So that being said, George is going to lead off. George and his associate, Henry Dreyer, if that's okay with you guys. We will call upon you to give your impressions, and then the remainder of the panel will give their respective impressions, and then we'll have a question and answer period. George and UBS Financial Services have been members of the BRI since 2012. George is a Senior Vice President of Wealth Management and a Senior Portfolio Manager of his company's Portfolio Management Program. As I mentioned earlier, he is joined this evening by his associate, Henry Dreyer. So at this point, we'll turn it over to George and Henry, and they will begin the event.
Okay. Hi, as Albert and Jeff had said, my name is George Canis. I'm with UBS Financial Services in White Plains. I'm a financial advisor. I have a wealth management practice. And basically what that means as a wealth management advisor is that we offer comprehensive investment advice, financial planning to our clients. This includes not only investments, but retirement planning, estate planning, and the topic of tonight's discussion, liability management. And we're going to talk specifically about how to use your investment portfolio to finance, a number of things, including real estate financing, business inventories, personal acquisitions, and so on, in a manner which is very cost effective, flexible, and very easy to set up. I'm very fortunate to have my colleague Henry Dreyer. Henry is a specialist in this area. He's a director with the firm, and Henry is one of the many resources I have within the firm who offers specialized advice and guidance for my clients. So I'm going to turn it over to Henry. He's going to talk more about securities-based lending and how this might work for some of you in your financing strategies. Thank you. Okay, go ahead.
So this might be financing that's a little different than the typical, commercial mortgage financing or real estate financing that y'all are, used to. What we do at UBS is, with George's expertise, asset management, we'll provide liquidity against clients' portfolios. So we'll look at a client's account, equities, bonds. We'll establish a different lending value of those securities. So, for example, a diversified portfolio of equities will get a 70% release, so you can borrow 70% against that. Bonds, if they're more conservative, high quality, we can lend as high as 95% against. It's really the most efficient, convenient, cost-effective way to borrow. These lines take maybe a week to set up. You sign a couple forms. There's no fees. There's no closing costs. The pricing is very aggressive. We base our rates off of what the loan's approved for. So for example, if you had a $1.5 million diversified equity portfolio where we'll lend 70%, we can provide a $1,050,000 line of credit. We have a pricing break point at $1 million, so meaning if we get your line approved for $1 million, you qualify for a rate of 30-day LIBOR plus 2.75%. Does anyone here know where 30-day LIBOR is at today? Is that something? 15, great. 15 basis points, 15, 16. So we're talking, you're close. We'll give you credit. 1 basis point, we'll play a slide. So we're talking an all-in lending rate of 2.9% on a $1 million line of credit. And that's not to say you need to borrow $1 million. It's just that's what you're approved for, and then you can draw whatever you would need off of that line and still get the $1 million rate. And as the value as the loan approval gets higher, the rates drop. So something over a $10 million approval for a very large loan, the rate would be at 1.9%. And I think you all have there's a rate sheet on your tables that show you the different pricing rate points where we price our loans. So we see a lot of clients use these lines for real estate transactions, and it doesn't necessarily have to be just for the entire purchase of the real estate, but they do see that. But it might just be for the equity down payment. So, you might want to take out a commercial mortgage for 70% of the value, but maybe you have, you don't want to liquidate your portfolio, it's performing well, you want to stay invested in the market, you have gains, you don't want to take a tax hit. So we'll provide the equity down payment against your securities, and you can still go out and get a commercial mortgage. What we see a lot of is our clients typically own the assets in their personal name, but they might want to buy the piece of real estate in an LLC name. So we'll have a client pledge their personal account, but we'll open the line of credit in the name of their business, of their LLC. So, it's a little cleaner for tax purposes. At the end of the year, they'll get their their annual interest statement in the LLC name. At the end of the day, they're still individually guaranteeing that loan. And, and one thing I want to make clear is, being against securities, you do still need to maintain a level of value to collateralize that loan. And if it drops below a certain level, there would be a margin call. So we always want to kind of be conservative, make sure there's enough assets, a well-diversified portfolio, because we don't want to get to that situation. But we see a lot of clients use these, pledge their assets, and then borrow in the name of their LLC. So it's a very common transaction. But you can theoretically use these lines of credit for anything. It doesn't have to just be real estate. It can be, we see a lot of wealthy clients help family members out. It might be, helping a grandkid start a business where they don't want to just give them $500,000, so they'll pledge their securities. It happens, I'm telling you, it's a great world to be in. But we see a lot of, so we can do, any type of third-party pledging. It's a great way to avoid any type of real estate taxes, because these are liens against the securities, not your portfolio. So, it's very convenient. The way the interest works is, it's a variable rate loan, like I said, tied to LIBOR. But where the flexibility comes is, we don't require actually monthly payments. So if interest does hit on a monthly basis, we always advise our clients to make a monthly payment. But in theory, you don't have to. So it's very flexible. We have clients who will buy a property, do improvements, and then look to sell them, and they don't want to put any at-cost, money during that time period. So they'll borrow more to do the construction phase of the project, complete it, never make a payment during this time, sell the property, and then one fell swoop, just pay off the line of credit all at once. So it really is a fantastic, way to borrow. It's much easier. We don't get into tax returns. We don't get into cash flow statements. Am I missing anything, George?
Yeah, I would just add that because some of the members here are also in businesses too, and the point about credit lines, business inventories, and how can be used in that regard.
Yeah, we see a lot of clients who are business owners who don't have. So if they're going to go to a regular bank, they're going to probably pay a rate of prime plus something. Have fees tied to that. Have to give cash flow statements, tax returns. We can take the business owner who pledges assets, we'll open a line of credit in the name of the business. We don't ask for any of that other stuff. There's not going to be any fees. There's not an annual cleanup for 30-day cleanup at the end of each year. So when we help a business owner finance the business this way, they're just ecstatic, because it's so much easier to deal with us as a lender. And essentially, once you set the line of credit up, it's approved. You don't need to use it, so it's not like at the time of approving it, you have to borrow at that point. So we have a lot of our clients who just establish a line of credit. They like having it available because you never know what's going to come up. And if they ever need it, they know it's there to borrow against. And if they never use it, it never costs them $1. So it's a free line of credit until you tap into it. And once you tap into it, you're just essentially paying interest on what you borrow. So, I think it's suitable. As the lending specialist at UBS, I try to have George set up all his clients with lines of credit, because I think it's always important to have liquidity available. The market goes up and it goes down, and sometimes it's not the right day to sell. And if you need money that day, it's nice to know that you can just borrow against it and always clean it up. And one last thing that George and I talked about is we see a lot of bridge financing. So, a client might list a property for sale. It's not going to close until December. They're looking to buy a property and they need to buy it in September. Well, we can, borrow against securities to bridge that 3-month gap. The fact that there's no fees or closing costs and an extremely competitive interest rate makes it by far the most effective way to bridge that gap. So, hopefully, I guess we'll do Q&A at the end if anyone has any questions. So, thank you.
Thanks, Henry. Thank you, George, and thank you, Henry. Our next speaker is Jerry Houlihan of Houlihan Barnes Realtors. Jerry is certainly no stranger to the membership of the BRI. He has served as chairman of the BRI's Apartment Owners Advisory Council and is a member of our association's board of trustees. He is a senior director of sales at Houlihan Barnes, which, as you all know, is a leading real estate company in our region and a longtime member of the BRI. Please welcome Jerry Houlihan.
Thank you, Jeff. We're a company that strictly does commercial real estate. We own and operate our own portfolio of office buildings, retail properties, multifamily buildings, and a couple of industrial buildings. And then we also do mortgage brokerage for third parties. So I'm going to speak directly to the commercial real estate lending environment. I guess over the first quarter of 2014, we've seen an uptick in some of the sales activity, and then competition from local savings banks has increased for owner-occupied investment, retail, office buildings, as well as some industrial buildings. The CMBS market and the Fannie Mae and Freddie Mac agencies have dominated the mortgage origination in the multifamily markets, although a lot of borrowers now will go to a local savings bank because the interest rates are so competitive to avoid the paperwork, the higher costs, and some of the other legal and administrative costs that go with that. And the lending policies, although are still strict, have somewhat eased over the, I guess, last year, the first quarter of this year, where there was any credit issues with a borrower, there was, banks would decline lending any money. But now they're starting to entertain different things, and we'll get creative with it. For instance, I'm doing a strip of a retail strip on Yonkers Avenue in Yonkers where the borrower has a credit issue, and we were able to negotiate a little bit higher of an interest rate and a little reserve, and it looks like we're going to be closing the loan soon. Some of the other things that they'll look for if there's a little bit of hair on the deal is, making sure that the lease expirations on either the office tenancy or the retail tenancy is coterminous with the terminal loan, so there's no exposure at the end. They'll look for a healthy debt coverage ratio of 1.3 or better. The typical loan to values are anywhere from 60 up to 75% loan to value. And they look for structurally sound properties with little or no deferred maintenance. The typical spreads that we're seeing from savings banks and as well as the Fannie Mae and Freddie Mac lenders are about 150 to about 175 basis points over the treasury bills or the swap rates. And then you go up maybe another 25 basis points or 50 basis points for office buildings and industrial buildings. And I just wanted to kind of read off some of the deals that we've done to give you an idea. We did a 51,000 square foot shopping center up in Unionville, Connecticut, 4% on a 30-year schedule at par for 5 years. We did a $20 million loan on the Grand Concourse on a former Verizon building, and that rate was about 4%, again, 30-year schedule. Both of these deals were done at par. A small building in New Rochelle, non-recourse, $600,000, 5 years, 4.25%, 30-year schedule. And what else today? And we have it's an apartment house in White Plains, $7.8 million, 3.75% on a 7-year term, 30-year schedule, declining prepayment penalty, and this is also done at par. The most competitive rates, obviously, are for multifamily buildings. We've seen them as low as 3.25% for 5 years at par, at about 70-75% loan to value. And I guess I can answer questions later. Thank you.
Thank you, Jerry. Chris? Okay? Great. One of our more active members at the BRI is Vincent Mutarelli, who's a vice president with Capital One Bank. Capital One has been a member of our association since 2006, and we're grateful that Vincent has helped us get Chris Economides to be part of our panel this evening. Chris is a marketing credit executive and a senior vice president with Capital One. And again, we'd like to express many thanks to Vincent Mutarelli for arranging for Chris to be with us. Chris, it's all yours.
Thanks, Jeff. We'll rotate from the table here up to the podium, so it's my turn to be back up on the podium. So thank you, everyone, for having me here tonight to speak. That gratitude also goes to my associate, Vincent Mutarelli, who's a great advocate for all the business here in Westchester County. He really is an advocate for the customers here, and he speaks and he works very well with them. So basically, I'm the market credit executive for Capital One. I'm responsible for all credit sales and business banking for the lower Hudson Valley, Connecticut, and the state of New Jersey, and I cover 18 bankers, but none of them keep me as busy as Vinny. And we basically lend into 4 sectors. We do traditional C&I lending, commercial lending, which covers term loans, lines of credits for operating companies. And then secondly, we lend to those owners who may own their building. Secondly, we do investor real estate. And what kind of investor real estate do we do? Well, we do multifamily, we do industrial properties, office buildings, self-storage properties, shadow anchored retail, and credit tenant properties. Of course, the most attractive property right now to lend into is the multifamily properties, because one of the key aspects we look at in lending is the vacancy rate. A multifamily in Westchester County right now is about 7.5% vacancy. And according to some statistics that I got from CB Richard Ellis, office properties, to give you an idea, are at about 19% vacancy rate here in Westchester County. So naturally, that type of lending is more risky than multifamily lending. Finally, we will do lending to condominium associations. That's a unique specialty that Capital One has, because when we're lending to condominium association, there's no underlying real estate collateral. We're lending to the corporation, a non-for-profit corporation that just owns the common elements of the association, whereas the individual units have an underlying deed and separate mortgage financing. So it's unsecured type of lending, and we do lend into that market, and we're one of the few lenders that do that type of lending. And finally, we do SBA lending for the folks who cannot come up with the traditional down payments required, like a 25% down payment on a property. Capital One will finance up to 90% of that property acquisition, and will spread out, and it will be a straight 25-year loan. Within our own, one of the things, on any types of these loans, Capital One retains its entire book that we originate. We're not selling our loans out to the marketplace, so we retain it. If Vinny originates a loan, he's going to service that loan for the life of the loan, and he's going to be the go-to person, and it's not going to be someone you have to re-explain the whole loan to. It will be Vinny and then perhaps myself dealing with the client. So that gives us some more flexibility in dealing with clients. That allows us to do rate modifications to keep a great client, just extend the terms. We love lending into the professional services market, to accountants, attorneys, doctors, and we will even go higher in our loan-to-value ratios, because we love that market, because the rate of default is so low in that market right now. Some of the types of properties that are tough to do are the specialty properties, the single-tenant properties where there's not a credit tenant, but it's always worth a discussion with us. Capital One, just a quick plug on Capital One. Vinny and I come from North Fork Bank, which was acquired by Capital One in 2006. North Fork Bank was just a true commercial lending bank, so Capital One wanted to get into that business besides just, you may knowing Capital One by what's in your wallet. We're a lot more than that. So I'll be happy to take any Q&A at the end, and I'll turn it over to the next speaker, Jeff.
Thank you, Chris. Thanks again, Chris. The final presentation from our panel tonight will come from Jim Lanfranchi of Webster Bank. Webster Bank has been a member of the BRI since 2012. Jim is a senior associate with Webster, and he's been active with our association since that time. He has spoken at several BRI meetings and seminars and has helped represent the BRI and its component group, the Apartment Owners Advisory Council, in issues affecting the AOAC, which is the abbreviation for the Apartment Owners Advisory Council. Jim is a very active member, and we're very, very pleased that he was able to join us this evening. Please welcome Jim Lanfranchi, Webster Bank.
What I want to start out by is introducing Webster Bank to you, because a lot of you may not know about Webster Bank. Webster Bank is the largest New England-based commercial bank. We're based in Waterbury, Connecticut, founded in 1934 by William Webster Smith. Borrowed 25 grand from his friends and family. But you can imagine, if he borrowed 25 grand in 1934, he probably had money himself. So he founded this bank, and it was a single branch bank until 1959. So if you remember It's a Wonderful Life,
Oh, yeah.
this was the building and loan. This was the building and loan. William Webster Smith took money from the people in Waterbury, Connecticut, the people who worked in those factories, and lent it back out to the businesses and homeowners at the time. And that's what we based our business on. In 1959, he opened a second branch in Waterbury. In the mid-60s, his son, Jim Smith, who is now our chairman, joined the bank, and as most children are wont to do, had a better idea. And he grew the bank and started opening up branch offices, took the bank public. We are now a $20 billion bank, based in Waterbury, but located with 180 branches between Boston and the Bronx. Next year, we hope to be opening another office in the Bronx, and we just received lending authority in Rockland County, the Bronx, Manhattan, Queens, and Brooklyn. Okay? What we do well, what we really do well, is lending to businesses and lending to investment real estate. And I was asked to talk about what the current market is. Okay, so now you know a little bit about Webster Bank. By the way, we currently have 8 branches in Westchester County, if that means something to you. Although most of our customers don't go to branches. We try to get people to bank without branches, and it works well. But in any case, what we do well is investment real estate lending. And I was asked to talk about the climate for investment real estate lending. What we've seen basically is that when the snowpack melted, the buyers have come out. That people are coming back to the marketplace looking to buy buildings. And yes, investment in residential real estate is always hot. The cap rates are great. It's something that people really want. They understand. They understand people need a place to live. But Nick pointed out a year ago that the real focus of the next 5, 10 years is not going to be on residential real estate, because the business community is building up again. And one of the areas that's lacking is flex space, is that warehouse space and industrial space. Nick and I do a lot of lending in the South Bronx and industrial parts of Westchester County, where there are not a lot of vacancies and there's not a lot of properties for sale. So if you're an investor and are interested in lending, or interested in borrowing or buying in that space, there's a lot of opportunities to get involved, both as an investor, as an owner-occupier as well. One of the things that Webster is keen on, and I think most of the banks in this room will talk about, we don't lend to buildings. So if you come to me and tell me that you have terrible credit, and you have very little put down, and you have very little liquidity, but you're giving me a 30% loan to value, we're really not interested. I'm not lending to a building, I'm lending to an individual. We like to see people with good credit. We like to see professional owners and operators, people who have experience, people who have liquidity, so that if they do lose a tenant, or they suffer a casualty loss that's not fully covered by insurance, that they can survive 6 months of a rent dip. In terms of interest rates, we are doing, Webster Bank anyway, is doing a lot of swap contracts. And an interest rate swap simply exchanges the risk, the interest rate risk, from the borrower to the bank or a third party. And what that means is there are no prepayment penalties provided interest rates don't go down. What do we say the interest rate was on the 30-month LIBOR? 15 basis points? 15 basis points. If you think the 30-month LIBOR is going to go below that, then don't take a swap contract because you're not going to win. But if you do bet against it, the bank is going to hold that risk. Okay? As far as other interest rates and what's happening in the rest of the market, I'm very bearish on interest rates. Everybody thinks the interest rates are going up. And a lot of the bankers that I work with feel the same way, because we understand that if interest rates went to 5.5%, 6.5%, 7.5%, then the federal government would be paying the same interest rates. And I think you know that we can't afford that. So as long as they can afford to print money, interest rates, it's in the country's best interest for interest rates to stay low. I think we're all very bullish. Everybody in this room, I think, is all very bullish on the investment real estate and owner-occupied real estate. If you have an opportunity to buy a piece of property now, it's a great time to buy. Interest rates are perfect. The lending climate has improved dramatically. Several of the panelists talked about how it's eased. I don't know that it's eased all that much. We're just focusing on people with very good credit. You know, the federal government is focused on the kind of credits that we issue, because they now believe that, or they've impressed upon us that we're not lending our money. If you're federally insured, you're lending the federal government's money. So you're going to lend to our criteria, not the bank's criteria. So if you know somebody who's been turned down for a loan and they complain about it, for the most part, the bank is not turning them down. It's the regulators that are saying you can't make that loan because if it doesn't stand on its own, you can't make it. I think I've answered every question I could about Webster Bank. I hope I've spoken enough about what the lending climate is like. And if you have any questions, Nick Mara, who's the new regional manager for Fairfield, Westchester, and everything south, is here as well. The little patch of real estate in the New York metropolitan area. We're here to answer your questions. One last comment. If you owe the bank $100, that's your problem. If you owe the bank $100 million, that's the bank's problem.
Thanks, Jim. Questions? The floor is now open. This is your chance. Anyone?
What's that? Questions?
Jeff,
Yes, sir.
you know, being out here in the audience, I know.
Could you identify yourself?
He's Italian. Yes, my name is Terry Grant. You know, sometimes the lingo kind of gets away from us, and you know, politicians use beltway speak and all that. But when you use the term par, exactly, you know, for the benefit of the audience, what does that mean? I know it was used by certain people.
Jerry.
Jerry.
Par simply means that the bank isn't charging a commitment fee. That's all it is. I mean, they'll you know, you'll have legal fees associated with it. You'll have processing fees, but you know, at times they'll charge you a commitment fee. If they quote you par, they're not charging you a commitment fee.
No points.
No points.
Any other questions?
Anyone else?
Nothing to do with my golf game.
Gene DeResta. Gene
Anyone on
DeResta.
the panel?
What kind of advice do you give an individual who wants to develop a property, a vacant lot? What's the best strategy in today's market to developing a vacant lot?
Pledge securities.
I would just add, well, after they get the securities loan and they want the securities back, they can come to Capital One for a loan. I would say if somebody's looking to develop a vacant lot, you really have to do a thorough market analysis in what you're looking to develop on that lot. As I mentioned, here in Westchester County, the vacancy rate on multifamily property is about 7.5%. So your ability to get that property stabilized, meaning rented up, is far easier to do so than if you had commercial office space, where the vacancy factor in commercial office space is about 17.5%, and it was a few years ago up in the low 20s. So that makes the office space market a buyer's market today. Whereas if you're developing a multifamily lot, it's an owner's market. So that's one of the major things one has to take into consideration when they're developing a lot, and then of course the local zoning and the local variances within that marketplace.
Jen, I mean, the first part of the problem, and it's an appraisal problem, right? It's an appraisal problem. The first part of the problem is, what's the highest and best use for that property? The highest and best use for that property might be a parking lot. The highest and best use of that property may be a vacant lot, because the real estate market in that area may be changing dynamically. There may be dynamic changes that are going on where you're better off sitting back and looking at it. If you're in an industrial area, you definitely don't want to build an apartment building. If you are in an office area, you definitely don't want to build a manufacturing facility. It's to my colleague's point, you want to look at what the zoning allows, but the appraisal problem is called the highest and best use. What is the highest and best use of that specific property? And that's where you would start. What's next door? What's down the block? What's coming? What's coming in the future?
That's the big question that I think people miss right now with multifamily construction. Is right now, I know it's a hot product, you know, you're looking and you're seeing rents going up, and that's great, but what ends up happening a lot of times in the construction business, in general, multifamily, is you're basing your project on what's going on right now in the market, instead of what's going to be going on when your project is finished. And that could be the crucial element to success or failure. Because, you know, obviously we've all seen that salaries are not going up. And everywhere you look, multifamily is definitely going up. I mean, if you go down to Hoboken, it used to be an area where, I know when I was going through college, everybody graduated college went to Hoboken. You enjoyed every bar there until you got a real job in Manhattan, and then you commuted into Manhattan every day, or maybe got an apartment in Manhattan. Well, Hoboken's not like that anymore. Now you got young professionals with kids in Hoboken, and there are actual builders down in Hoboken that think they can get 1.2 to 1.3 million condos, or three-bedroom condos in Hoboken, which you would have never thought 20 years ago. You were scoffed at. But you know, you do have a mayor in Manhattan that seems to like the tax code, and that seems to be pushing a lot of people out into areas like Stanford, into areas like Westchester, into areas like New Jersey. But you gotta, you know, it's also, you're starting to see a ton of real estate going up, and just like anything else, supply and demand. If you get into that marketplace and all of a sudden all these other buildings are going up, and now rental prices that you thought you were going to get are not what you're going to get now, because it's just there's places to rent everywhere. And you're also anticipating that most people that are young are not buying houses right now. They're a little scared of the housing market. They're scared of what the house is going to be worth. They're scared of property taxes. That fear might not always exist in a couple of years. So those are kind of things that you know, you get caught up in a project and it looks great and you see what's going on, but it's really you know, in my estimation, and Jim touched on it earlier, is my feeling is that nobody's putting up a commercial warehouse right now. Nobody's putting up spaces, and you have apartments going up everywhere. But people still need to get goods and services into the boroughs, into Queens, into Brooklyn, into where's it going to come from? So, you know, there is a lot of space that's out there right now, and I think if you got a smart investment hat on, I think there's a lot of room in the industrial and heavy commercial areas, because there's not many areas left, and certainly there's not a mayor that you can think of that's saying, please bring your warehouse space over here, we'd love to have you here, and please bring your trucks and everything else here, but you know what, you need trucks to supply product to people, and you'd be surprised in a year what the market might look like. You don't want to be late to the game, and you know, I'm starting to feel like people are going to start getting late to the game as multifamily moves.
Mr. Lashes?
Yeah, I believe the gentleman's question was, what's the best way to finance vacant land? And you finance vacant land without any approvals. The approval process takes a long time. And I would say the best way to finance vacant land is the way the founder of Webster Bank financed the bank initially. And that is, go to your friends and relatives and you do it all with equity, no debt. Because you have no idea how long it's going to take, and the carrying cost with the taxes and the approval process, and then interest and debt service on top of that, becomes very difficult for the landowner to carry. So my advice would be to do it all with equity.
It's great if you can do that, and I will tell you that getting a development loan from a traditional lender is very difficult. We want to see experienced developers. If you come and say, you know, I got this piece of property, and I think I could build a house on it, or an apartment building, or a factory, it's not going to go very far, because we want to see experienced developers. We want to see people who know how to make a project from beginning to end, and that's the key. And also, if the project costs $5 million and you're looking to borrow $4.5 million, well, that means that we own the project, and we're going to lease it back to you. What we're looking for is somebody to come with us, say, here, I got all this cash, I only need another $1 million to do it. And that's like what people always say, banks only want to lend money to people who don't need it. No, we want to lend money to people who need it, but who also understand what they're borrowing and why they're borrowing.
Banks primarily lend against cash flow. If you look at doing a home mortgage loan for somebody, the bank's going to qualify that individual on a home mortgage based upon their income. They're going to look at a debt-to-income ratio on the house, on the borrower, and then take an underlying value on the home. It's the same thing with a business loan or real estate loan. The preferred loans in today's market are those properties that are stabilized and are generating a cash flow. Something like like you said, borrow money from family or friends. There's non-bank lending institutions, venture capital, that will lend in to these vacant lands if they like the property, but they're going to take an equity position.
Well, that's what I'm talking
Yes.
about is equity.
Yes.
So that there is no debt service.
Right, because when a bank lends into a property, we're not getting the equity upside on. We're getting our 3, 4, 5% return on the loan, but we're not participating in that property's growth in that property's value, whereas an equity investor would.
I'm very dangerous.
I've been out with you.
Are there any more questions?
Vernon's speaking.
Can you stand, Mona? So we
I
can
can
hear
repeat the
you.
question just for those who can't hear.
Okay. Here we go. Thank you, Jim.
Go ahead, Mona. You can do it.
You're on.
Many years ago, Long Island City was poison. Tenements, very poor area, buildings falling down, probably buildings before 1900. I was working with some attorneys in real estate at that time. They kept saying, or late seventies or the early eighties. We only had a lot of money to buy a lot of those buildings that had to be torn down. But somebody did buy them. And Long Island City now is a suburb of Manhattan. And I'd like to know how that happens. Is it down banks, is it down private people? And Long Island City is gold.
I'm not an urban planner, but I read maps like most people read novels. And if you look at the transportation network, specifically the E, the F, and the 7 train, the E, the F, and the 7 were the answer to why, and Long Island Railroad to some extent, but the E, the F, and the 7, which have they're one stop away from Midtown. That's the reason why Long Island City grew the way it did. That's why Citibank built that 50-story tower. I worked there for a while. One stop away from their headquarters. And if you're looking at where the future is going, I think we pretty much stopped on expanding out into the suburbs, because I remember as an appraiser 10 years ago, looking at the Durst organization and other organizations taking options on property in northern Dutchess County and trying to figure out where the people who were buying these houses were going to work. And were they going to work in Albany? Because you were almost closer to Albany. You were almost equidistant. Were they betting on the fact that there was going to be high-speed rail to take people down? Because high-speed rail is not, it's too far away. By the way, the Durst all those organizations have bought these long-term commitments, long-term options, and they've all given them up. That property is still not going to be developed. But what's going to be developed is my kids who grew up in northern Westchester have no desire, and all their friends, by the way, have no desire to live in the suburbs. None. Everybody wants to live in the city.
Right. If you look at it, Jim, there's a lot of vacant, large, corporate office space, industrial space, corporate campuses that are vacant in all of these suburban counties. If you look in Bergen County, North Jersey, expected to underperform in the office and multi-family housing and industrial markets. Bronx is considered to be average. Brooklyn, average. Manhattan is going to outperform, is expected to continue to outperform the market. All the outlying suburbs, Westchester, underperform. So it goes back to what you said, Jim, about the boroughs of New York, and the 4 boroughs are expected to remain. Queens, Brooklyn, and the Bronx are all expected to outperform the suburban markets.
Don't leave out Staten Island, they're very sensitive.
Staten Island.
No Staten
No, the boroughs is performing.
Staten Island.
All the 4 boroughs are doing much better than the outlying suburbs of Bergen, Westchester.
Well, I just want to say, if there are no further questions, we covered urban planning, economics, and whatever. We have time for one more question. Stand up, identify thyself, and project.
Steve Hess, Keller Williams Realty. Would you attribute to the lack of progression into the suburbs at this point because of the tax base, the cost, versus in the boroughs? Is that versus, let's say, Westchester? Vernon, Yonkers, New Rochelle, industrial. Why would that not be moving out because of the taxes?
I don't know. I can only speak from my perspective, and I think the perspective, if I look around the room, the perspective of most of the people who are in this room,
Right.
I think most of us probably grew up in either down county or metropolitan or in New York City. I grew up in the Bronx.
Same here.
Okay.
Washington Heights.
Washington Heights. My wife grew up in Washington Heights. I would have loved to have bought a house in Riverdale. Couldn't afford it. Okay. I went first to New Rochelle, then to Scarsdale. Kept moving at White Plains, and finally Pound Ridge. I found something that was cheap enough for me to buy. But now, and that was the reason I did it, it was just home prices were lower. I can't afford to stay there, honestly. I think probably by the time I retire,
Site, but
taxes are gonna be a major factor. But here's a bigger factor. When my son was getting ready to go to college, and I suggested that he go to Purchase, SUNY Purchase, because he could commute, he told me, "Daddy, I'm leaving here in September and I'm never coming back." And the reason, I said, "Why do you say that?" He said, "Because this is like growing up on a desert island with trees." He said, "There's nothing here." And if you watch modern TV, and if you look at social media, it's all about interacting and communicating with people. And if you're in the suburbs, your ability to do that is limited, you know? What everybody's looking for is the ability to interact with others that you can't get in the suburbs, that you can get in the city. Because that's what you see on TV, that's what you see in media, whether it's social media or the public media. That's what you see.
You hit the nail on the head. Everybody wants to be one stop away on the subway or one stop away on the train.
Exactly.
Well, we're coming up on 8:40. I have to say, just on a personal note, I don't understand all this suburban bashing. I grew up in the country. I was born in Mount Vernon, raised in Mount Vernon. You know, I just...
Mount Vernon is the country?
I was waiting for somebody to laugh. A couple of, before I turn it over to Jeff to wrap up and thank our guests, a couple of extra announcements. One, if you haven't gotten your parking sticker, please see Jeff after the meeting and get it, otherwise we'll cover the parking, but if you don't get your sticker, you'll have to cover it. Secondly, any guests or members who do not fill out either a yellow or green card, just please come up and fill one out for us. So it just helps us to keep tabs on the actual attendance when we have to settle the billing with the Crown Plaza. And we were remiss, hold on one second, don't anybody leave. We were remiss in trying to get the program going. We forgot to acknowledge both our president, Eric Abraham, and our chairman, Mike Goldman. And thank you to all the directors of the heads of the 5 families who may be out there. And let me turn it over to Jeff for a final adjournment.
Thanks, Albert. Once again, our next general membership meeting is May 15th here at 6:30. Please keep an eye out for that and other notices on our meetings and programs. Please help me in thanking Jerry Houlihan, Jim Lanfranchi, Chris Minis, Tony Drug, and George Hannes. Thank you all. Great job. Everyone have a good week.